Hey, everybody, it's Larry Berman here. Very interesting week coming up, of course, with the FOMC, what's priced into markets, what's not priced into the markets, what to expect. Lots of data on the calendar, lots of data out in recent days and weeks that really presents an incredible conundrum, the least of which is the unrealistic expectations of what's priced into the market versus, I guess, what we're likely to see over the next year. Let's dive into the chart room and see what we learned this week. Non-farm payroll Fridays is always an event in itself. Whisper number was a little bit softer. Actual came in a little bit hotter, but when we read through all the dissections of the data from various Wall Street firms, pretty much the broad conclusion was when you think about the strikers coming back and this and that, next this and that, it's clear the labor force is slowing. Up until this report on a year-to-date basis, we saw virtually no growth at all in full-time jobs in the household survey. What's the household survey? Well, it's different than the establishment survey. So the 199 number you see is the survey of asking companies how many people they employ. The household survey, they call your house and say, do you have a job? And how many do you have, and all that kind of jazz. And that one added a tremendous amount. It's that survey that they get the unemployment rate from. So we saw a massive uptick in terms of the number of jobs gained in the month of November. When we contrast that, we saw a increase in labor force participation, but not nearly to the same extent that we saw new jobs. Hence, the unemployment rate came down. It's going to be very difficult with these numbers for the Fed to paint any sort of we've done our job this week. Now, I don't think anyone was expecting that. Obviously, the Fed is on hold. That shouldn't be a secret to anyone at all. The mathematics of the CPI, when we look at what's coming this week, the Fed will see the CPI on Tuesday, the day before their decision making. When we look at the numbers, this is probably going to be the bottom of the core number, where mathematically year over year, what drops off, the drop off effect, and what comes in. The next 6 months, it's going to be very, very difficult for this core number to get much below 3.5, and maybe will be sticky around closer to 4. Now, you got the rents component and everything else that is going to play a factor as always, and many are arguing that the rents number will bring this down. So, but stickier. The year over year numbers, again, it's going to be very, very tough to get them down to 2. Now, many Fed speakers in recent weeks, we've been in blackout this week, but in recent weeks say we don't have to wait until we actually hit 2. They have to be confident that they've done their job. And in no way, no shape, no how in any of the next 6 months, I can't imagine that they can gain that level of confidence. They all suffer from recency bias, and the recent data is good. Powell, in his last presser a week ago plus, said as much, that the 6-month rate of change in the data is very, very good, but we're not there yet. I expect, with financial conditions easing as they have, that the Fed will push back significantly on the dot plots. Market is expecting 5 rate cuts through all of next year, 4.45 to be exact, by the December meeting. This number was close to 6 prior to today's data and this week. So the expectation was really for even more rate cuts, and today's data obviously slowed that down a little bit. When we think about the economy, on the other flip side of this, so leading economic indicators have been in recession all year. In fact, it's coming up on 16 months or 17 months consecutive where the leading indicators year over year are below zero. Obviously, there was some smoothing out here and lumping because of the COVID impact of that rapid decline, shutdown and open. But nevertheless, when we look at the history of what markets do, the behavior, the performance of different investment factors, Bloomberg ran a study we're looking at here that once we see a prolonged period of leading economic indicators turning down as we have, and then we say, well, what performs best going forward? It's clearly the stuff that's been beaten up, typically more value-oriented companies versus the high quality and momentum type companies that have been firing on all cylinders this year. As to it's always, folks, about future performance, not what's in the rearview mirror. And so those espousing a really bullish view here on equities are grossly misguided. Value and small cap that has not participated going forward should generally do better. When we look at the reaction of the bond market to the data today, we can see clearly a shock up. We saw both on the 6th and 7th where bond yields in the long end came down to almost 4.2, where the 10-year is about 9 basis points lower than that. And it looks to me at this point like the term premium on long bonds is just zero. So what is an investor now getting paid to take interest rate risk? The answer is nothing compared to short term for the next 6 months anyways, before the Fed even thinking about cutting rates. So what is the Fed going to tell us this week? I think the dot plot might have a marginal move. So from an expectation of 50 basis points in rate cuts, which was what we saw in September, to moving some of the members, maybe a little bit more than that, but nowhere close to the 125 basis points we have priced in for next year. So there's bound to be some disappointment. I expect Powell in the presser to be somewhat balanced, but really want to contain the irrational exuberance that's coming into the marketplace now. When we look at TLT, so that we looked at 30-year yields, when we look at this, you can see the rally up towards long-term trend resistance, of the year, rally back to trend, and then much more shorter term. Very overbought in terms of the bond market. We already talked about on the yield basis what we saw here, that yields are now back to pre-levels where when Janet said we got to issue more coupons, bond yields moved higher. That next QRA announcement is end of January, first day in February. That announcement will be critical. The Treasury supply that's coming, QT plus deficit, pushing well into the 2 trillion number next year. The rally's done, folks. I can't see it continuing here, which means that if the quality component or large cap tech duration type names, that rally's probably best in the rearview mirror. When you look at top down and bottom up in terms of earnings expectations for 2024, the strategist median year-end target for next year is 47.23, 2.6% growth based on a 4% EPS growth target and a 20x multiple. Guys, this is nirvana perfection priced into the market. When we look at it from a bottom-up perspective, so again, what this study does is it takes every analyst that looks at underlying stocks and their 12-month forward price target and weights it by the weight of the S&P 500, that number a year out now is here, 506183. Again, that's every stock hitting its 12-month price target at the same time, weighted for the index. So again, those looking for a lot of upside here on equities, I think are grossly misguided. The market's already priced for perfection. Historically, when we've seen the current market get one standard deviation close to where that perfect long-term price target is, this is a bad time to own equities. Bad time to own equities. Bad time to own equities, and rinse and repeat over history. So that's it from my lens, folks. Caution still the message. I know, Larry, markets are grinding higher. You're looking dumb at the moment. Don't buy into the fear of missing out. Have a great week, everyone.